officially live on the Not Your Average Investor Show, Tuesday edition. We're here to talk about remote real estate investing. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because he's got these genius concepts, knows how to generate cash flows. He's a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And with us on the show, as always, is our superstar marketing teammate, Madison the Magnificent, the community manager. Madison, say hello to everybody.
Hello, everybody.
And the star of the show today, he is a real estate investor himself. He's the head coach over at Roofstock Academy. He is an accomplished outdoorsman, surfer, snowboarder, whitewater rafter. I think he just got off of a whitewater raft right now to come on the show. Diver. He does all sorts of cool stuff, and I'm dying to be his friend. And guess what? It's happening. Michael Albaum, welcome to the show, bro.
Thanks so much, guys. You forgot to mention a professional dog puke receiver as well. Let's add that to the resume.
Podcaster that is immune to dog projectile vomiting. Total pro, folks. Total pro. Michael, welcome to the show. We are pumped to have you. We are pumped to have you. If you're watching us on YouTube, if you're listening on the podcast, just maybe walking your dog. Who knows? We love having you on board, but our favorite folks are the folks that show up live here, our community that go to nyais.com, register, put it on the calendar, make a point to show up every once in a while, and we reward them with the roll call.
Love it.
You ready for the roll call, Michael?
Let's do it.
Let's go. Madison's already in the chat saying, welcome to the Not Your Average Investor Show. We got Jag Chada checking in. Good morning. We got John Henning. Good afternoon, all. We got Chris Consaga from the illustrious Hudson Valley of New York saying, great day, everyone. We got Dean Curry checking in from Columbus, Ohio. Good afternoon, Dean. We got Shelly Johnson. Welcome, Shelly. Greetings from Bradenton, B-Town.
Love it.
As I like to call Bradenton myself. We got Drew Barnhill, the ringmaster of the Not Your Average Investor Show community. Welcome back, Drew. We got Leo Faraganan.
Dun, 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 dun.
Faraganan. Good morning,
Dun, dun,
Leo.
dun.
All the way from the Bay Area, California. Let's rock. Leo was in a hair band, Michael, so he might be recruiting you a little bit after this. We got Miguel Angel Sanudo. We got Miguel Angel Sanudo coming in from Granada, Spain. Hola, amigos. Good to have you. We got David Singy. He's back. David, you're becoming a bit of a regular on the show, and I like it. He says, good morning from San Diego. Speaking of great surf, Alicia Wilson. New name?
New name.
Alicia. Good to see you, Alicia.
New name alert. We love new names.
Here from Fort Lauderdale. I'm a South Florida person myself. Miami, but South Florida, we share a couple things down there. We got Lee Bishop, the MVP of the Not Your Average Investor Show community. He's in the house. We got Leslie Wilson, one of our favorite community members here from Denver. Leslie, good to have you back. We got Denny Davies wishing us a happy Flag Day, everybody. Honor your stars and stripes, Danny.
Oh, wonderful message there, Denny. Appreciate you bringing the service component here.
Yeah, Danny, thank you, man. We got Carl Thompson checking in from sunny Colorado. Carl Thompson's Facebook name is like Bebe Carlos or something like that. It's like Bebe Carlitos. It's fascinating.
Oh, yeah?
I want to hear that story, Carl. We got Noah Rundari. He's back. Good morning, everyone. Greetings from California. We got Ken Moline and his wife, Carolyn, the matriarch and patriarch of the first family of the Not Your Average Investor Show community. We salute you. we got Nadeem Shah. He's back. Howdy, JWB family. Sergio Prieto is in the house. Go Gators. We got our regular Rosalind Riley checking in from Murrieta, California. Carl Thompson, it's Bebe Carlos.
Bebe. All right.
Bebe Carlos.
Love it.
All right, Carl, it's good to have you. Glad we figured it out. Speaking of Bebes, Michael, it's good to have you here, Bebe. Why don't you tell us a little? Oh, all right, I'll let you catch your breath. Michael Sweety's checking in from Virginia Beach. Michael, welcome back.
All right.
Good to have you. Michael, we like to start this. We like to just cut straight to the chase after we giggle around for a little while and just talk about this idea, remote investing. Why is it so important? Why do people need to know about remote investing, Matt? Talk to me.
So first off, that was like the best intro I've ever been a part of or been witness to. So kudos to you guys. Thank you all for that. So I think remote investing is such a critical part, and if it's not already, should be part of everyone's investment plan, because if you're only investing where you live, you're really limited. And that was really how I got started. It was expensive where I was living and it just didn't make sense. I didn't understand it. I couldn't break into that market. And so I said, okay, if I can go to another market and do the thing that I'm already doing, and figure out how to do it, it's open, like the world is your oyster. Literally, the world becomes your oyster. And so I get my start investing in Southern California, actually, where Rosalind is calling in from, in Marietta, California. Believe it or not, that was my very first investment. So it was like
Inland
3 hours
Empire.
south. The Inland Empire, exactly. Yeah. So it was like 3 hours south of where I lived. I grew up going there as a kid, so I knew the market, but it wasn't in my backyard. And so I said, let me take this thing, real estate investing, that I just learned about for 2 years, and give it a try, and we'll see what happens. And that really started kind of the domino effect as, well, if I can do it 3 hours away, I can do it 6 hours away. And if I can do it 6 hours away, I can do it 10 hours away. You do 10 hours away, you do a different country. So it really gave me the confidence to expand my horizons and expand the purview and scope as to where I physically could invest. Because investing, the principles are the same. Anywhere you go around the world, they're the same. Basics, fundamentals are the same. What you're changing is just the locale and the local players on the ground.
Absolutely. And I always think that there's this double standard of investing versus how we make decisions and what we deem as important when we buy stocks or mutual funds or bonds or whatever, but mainly stocks here, right? And then the standard that we hold rental property investing too. And in the stock market, right, we buy assets, we buy companies, and they're all over the country and all over the world. And in real estate, we say, oh, wait, no, I'm not going to go outside my neighborhood. Like, that doesn't make any sense, right? So, but this is a hard concept for people to become comfortable with and then take action on. Michael, what was it for you? What led you to the place where you were like, listen, I'm going to grip it and rip it and try something 3 hours away from where I live, and then build that muscle and get to 6, 10, and states away, I'm sure, for you now. What was that major turning point for you that said, yeah, I can do this?
I think for me, it was just kind of necessity is the mother of all invention. Like investing where I lived, I was living in the Bay Area, California, like just not an option. And so I said, okay, well, where is this? Like, where is this an option? Where is this feasible? And so it just happened to be in Marietta, California, but it could have been in another market that I ended up in. But I think I didn't know any different. Like, I had never invested locally before, so I didn't know that I was taking a big risk by going somewhere else. And so I was too naive and too green to really even realize what I was doing. I was like, oh, this is just like, whatever. I think this will work out. And so I think if someone is privy or has invested locally, that's probably a bigger hurdle to overcome as to, well, I understand what this is already like. For me, it was just my first time. I didn't know any different anyhow.
Man, that speaks to me so much, dude. Cause I like you, not as I didn't grip it or rip it. Right. But while I was living in Miami, I had a really hard time thinking that I could invest there. Right. Like I kind of see this, I look at this rental investing game and I think of it as kind of like you're at the Bellagio and there is a $10 craps table. I love playing at the $10 craps table. If you put me in the $50 craps table, I start to get really uncomfortable. And if I sit down at the $500 craps table, I don't even want to be there, right? Like I'm just terrified out of my mind. It's not a good experience. By the way, I've never played $500 craps, just for the record. Yeah. But it's kind of the same thing, right? Like these different markets are these different stakes and comfort levels that you can play in. And when I was in Miami, I was just way too uncomfortable doing that. One, for the price, two, for my long-term outlook of the Miami market. But I knew that Jacksonville was a place, right? Like I was doing private lending with JWB, but I hadn't put together the idea that I could actually own a rental income property in a place that I didn't live. So when it took me coming here, being the host of this show, doing it for a year, to that now I'm like all in, right? Like I recently cashed out my IRA. I'm all in. But what was it for you, man? Like how did you figure it out at the time? What year was it? What were the tools? Like how did you start making yourself comfortable with? I mean, Bay Area to Marietta is not a 3-hour drive. That's a pretty long drive.
Right. Yeah. So I spent like 2 years getting self-educated back in 2012, and before Bigger Pockets was around, or before Roofstock was around. And so I was just piecing together these different pieces of information from books, from websites. And I just said, okay. And I read Rich Dad Poor Dad, right? Like I think so many of your audience and viewers did. I was like, oh yeah, this makes sense. Mm-hmm. This totally makes sense. And I was an engineer at the time. I was working as a fire protection engineer. So like I spoke in math. Like equations were my jam. And so I was like, Excel, awesome. Like, let me just run the numbers. And so I spent 2 years doing that and just running property after property after property. And so I grew up in LA. And so Marietta was just south of there. And so I knew the market ish. Like I knew that there was this good pizza restaurant I like to go to, and I knew where my grandpa's mobile home was, where we went to spend weekends. And so we knew a property manager and agent. And I just spent 2 years getting educated, running deals, running numbers, and then spent about a month down there back and forth with the agent, property manager, figuring it out. And like you probably, it was just like so far outside my comfort zone, the property she was showing me. I was like, 200 grand, that's kind of where I'm comfort. That's like where my pickle jar zone is, where I'm feeling strong, feeling good. And everything she showed me was 300 plus. And I was like, what? Like, there's no way. That's not 200. So it took me a long time to really wrap my head around, okay, well, if I take a step back and see 300 is this massive, huge number, but what's my actual monthly exposure? What's it going to take if this property doesn't get rented for 6 months? What does that picture look like? And we do the same thing in insurance. We quantify the risk, and then we figure out how do we mitigate the risk. And so I said, okay, let me apply what I do professionally at work to this thing I'm doing, this real estate investing thing. And once I could wrap my head around that and get comfortable with it, I was like, oh, it's really not so scary. And of course, no one wants 6 months of vacancy. That's a bummer if that happens, but I'm not going to have to eat top ramen for the next year of my life if I had vacancy for 6 months. So I said, I'm comfortable with this number. Like, I'm good with it. Let's go. And there's another story I chat about on the podcast that involves like human feces on the first tenant leaving that property. And like, that was a whole thing, but it ended up working out okay. But so I think that's what I did. And that's what I recommend other people do is like, look, go get comfortable with the worst case scenario and understand what your upside is. And the reality is probably going to be somewhere in the middle.
When you're getting comfortable in the worst case scenario, are you comparing it to another scenario, right? Like we've been having this conversation right now. Like, how do we make the feeling part of it more comfortable, right? Like there's numbers and then there's feeling. And I've been like pushing Greg. I'm like, Greg, how do we show, kind of like cash flow? If I'm 50 and I'm this far from retirement, and cash flow versus not, whether like the stock market takes a dip, right? Like I'm trying to like draw up all these different scenarios that we can compare the most uncomfortable part of rental property investing. Are you comparing it to other things, or are you simply just thinking, okay, six months without a tenant, that's going to cost me 10 grand, but the chances of that, are you like going actuarian of just like figuring out a percentage of like that happening and then plus the upside? Are you comparing it to itself, or are you comparing it to other things?
So I started comparing it to itself, and it wasn't until I had additional rental properties that I started comparing them to each other or to other alternatives. Mm-hmm. At the time, I was like, oh, cool, I'm going to make $200 a month on this. That's awesome, because that's more than I make from other passive investments, which really didn't exist at the time. I had stock market stuff, but I wasn't investing in dividend stocks. So I was like, $200, awesome. That sounds like a good number. If I do that 10 times over 10 years, that'll be a good number. That feels good. It wasn't until I started owning additional properties, I was like, oh, well, I make $200 over here, so this property only makes $50 a month. Like, why don't I just go buy another one that makes 200? So I think you have to start somewhere. And so I think that's what a lot of folks in the academy, especially newer investors, do, I think, to their detriment. They hear people talking about making $200 a month passively, or they hear people making 10% cash on cash return and compare themselves or those investments to other investments. And it's like, wait a minute, no, just get started. Pick a number that's good for you and then go do that. And then the next one, do better than that. And the next one, do better than that. And so don't worry about what other people are doing, because they might have things that are going on in the background that you have no idea about. They might be doing it for longer. So pick a number you're comfortable with, then go make that happen, and then improve from there.
I mean, that makes a lot of sense. I mean, how many times have we heard people that want to invest in real estate and they're like, well, I really like that deal if it would give me $200 a month in cash flow, but at $175 a month in cash flow, yeah, I don't know if that's really what I want. And when you look at the big picture, if you know what it feels like to own these assets for 10 years, 15 years, 20 years, you look back and you think, well, that $25 difference in the cash flows is like this much of the total return on investment, right? And so if you've got every other part of the decision laid out and you're $25 short per month on cash flow, like you just hit a home run, right? Because usually you don't have every other part of it figured out. So, but what I was thinking as you were telling me this is, right, the value that you see being at Roofstock and really helping people invest remotely across the entire landscape, you get to see this perspective of what makes some markets really work well for some investors and what makes other markets completely different fundamentals work well for other investors. Could you help people understand what they should be looking for and tie it to maybe what their cash flow goals are or what their appreciation goals may be, and how would you help them choose the right market for themselves?
Totally. Just to take it like one step back, right? And talk about that $25 cash delta, like get Chipotle 2 times less that month. And then you made up that difference. So I think, again, kind of getting back to your question, Paul, was like people looking at the investment as this standalone thing. Well, yes, I think that's important to do. You also have to take in the greater perspective of your life. Like, what does that $25 mean for you in your life? So it's often, you know, like you said, it's just such a minor point. But so talking about markets, I think like the investment lives and dies via the property manager. I've said this for like my entire investing career because I've seen it go both ways, both really well and really poorly because of the property manager. And so I think you have to get really clear on what your goals are, because you have some people that are investing for tax benefits and they don't want cash flow. Cash flow is actually bad for them. And so they're picking a particular market. And so if you're sitting around chatting around with this person about investment properties, you're like, oh yeah, this market's great, but their goals are completely different than yours. And so you have to get really clear on, okay, what am I trying to accomplish? Why am I investing in real estate to begin with? Is it even the proper investment vehicle for me? Because by the way, it might not be, depending on your goals. And so I think once you get really clear on those, then you can start to identify, okay, these are the markets that support those goals. These are maybe kind of the middle markets in between my goal and maybe a different goal. And here are the markets that just don't even come close to having the type of inventory for me to accomplish my goals. So it really runs the gambit. And in a lot of markets, by the way, you can find, and I'm sure you guys know this, like you can find in one market cash flow properties, appreciation properties, and kind of balanced properties in different submarkets within that same market. So it doesn't have to be a completely different market. Maybe you're just not looking in the right neighborhood, or maybe you're not looking at the right street or the right block, because some markets are so hyper local like that. And so, and then getting with a team that can tell you and kind of guide you, hey, this is where you have to be looking, because we can all look at Zillow all day, every day, but until we get down to the nitty gritty details, I mean, it's tough to really pull the trigger.
Yeah. And I love what you're saying as far as how important the property management decision is. Most people just totally, keep that one for after they chose the market and after they chose the property. And then they're like, oh, I'll do a Google search and I'll find somebody. And that's just totally the wrong way to be successful in this asset class. That's the reason why a lot of people actually have a negative experience in rental properties. They try it one time and then they'll never do it again. It's because they flip that on its head. Could you talk about some of the things, and I'm not so familiar with the property management teams that you work with? Do you work with a number of different property managers for the properties that you own? Could you talk about some of the success traits that you've seen for a great property management relationship?
Totally. I think first and foremost, like communication. Number one is communication. If they're doing stuff in the background, that's all fine, well, and good. And I'm very appreciative that they're doing it. But if I don't know about it, I'm going to be anxious. I'm going to be calling. I'm going to be following up, because I'm very much a control freak being an engineer. Like, I know that no one's going to take care of my properties as well as I would take care of my property. So I want to make sure that this person or team of people are treating my property like their property. And so I'm checking all these boxes. I'm taking notes. I'm making sure that all these things are getting done. And so if I don't know that's going on, it's like doubling my efforts. Mm-hmm. And how stupid is that? Like, I could just go do it myself. Why do I have to pay someone to do it on my behalf? So communication, number one. And number two, I would just say, is like local market knowledge. Anybody can go start a property management company. But if someone like really understands the local nuances of the market, it can just blow the investment out of the water. And thirdly, I love working with property managers that are also real estate agents. And there's really, the reason behind that is, I always joke, you date real estate agents because it's very transactional. You can do a deal together, and then if it doesn't go well, they could be off to the next person. You might never hear from them again. But you marry a property manager. You're in that together. And so if that person is wearing both hats, well, if the real estate agent sells you a headache and you're using a different person for property manager, the property manager has to deal with that headache. Yeah. But if they're the same person, they're not going to want to sell you a headache. So it kind of, you're hitching their wagon to your horse, so to speak. And so that's something that I always like to look out for. Not a requirement, but if a property management is also an agent or vice versa, they definitely get a couple extra points in my book.
That's what we say at JWB. The same person who's selling you the property should be the same person that's collecting the rent, it's not exactly that person. They can have a team behind them, but at the end of the day, the reason that you do that is because there are so many opportunities to play the blame game in a rental property, right? Listen, the rent rate was set incorrectly, right? I didn't approve that resident to be in there. The property manager didn't manage maintenance costs the right way. They didn't talk nicely to the resident. And if that same person is not doing all of that, you pretty much throw your hands up when something goes wrong, because you're never going to nail that one. You're never going to nail those two people down to accept accountability. You're never really going to have a process of a passive investment that gets better and iterates and gets better and better and better over time. So I'm all in there with you, brother.
Love it.
As you guys talk about it, number one, I never thought about the fact that I've never considered JW to be a real estate agent, but I just feels like real estate agent is part of what you do. You are selling the property,
We
right?
just don't charge a commission.
Yeah. Well, when I think of it, I think I came from the construction industry before this, Michael, right? And I've very much lived the life of the architect and the contractor, right? And or the general contractor and the subcontractor, and the disconnect that happens there of like somebody is selling you one thing, but counting on somebody else to do something else.
Yeah.
And the inefficiencies of just like, no, man, I painted the wall right. It's just that the drywaller didn't do it correctly. And then the general contractor's just kind of sitting there in the middle. So for me, it's like, if you go into a design build situation where the same person designing it is the same person building it and they have all their labor force in-house, it creates a much better experience as a delivery mechanism. And I live that. And I kind of see it as this, right? It is realtor property manager, but at the end of the day, it's like the vertical integration of however many going to one person being the one that is the ultimate decision maker that controls as many pieces of like the equation adds to the quality of life, because you are now aligned in the same incentives. When you're talking about a realtor selling you something, they're the transactional, but the property manager is the boo that you marry, right? Like the idea that I gotta make you happy today, and I also have to make you happy as we grow old together, is kind of like what you're looking for, right? Like that, like aligned incentives, right?
So you're saying I'm your boo?
Too many of those jokes, man. My wife's getting very uncomfortable, Greg. We took a morning walk this morning. So Greg and I normally run on Tuesdays and Thursdays, but like I hurt my back a little bit playing spike ball this weekend. So we just went for a sunrise walk on the beach.
Yeah,
Nice.
we did.
That's
glorious.
awesome.
It was nice, but
glorious.
I came home and my wife's like, "All right, so you're going on sunrise walks on the beach with Greg now." All right,
Spending too much time with Greg, darn it.
I don't think there's anything wrong with that.
I don't think there's anything wrong with it at all.
I love it.
Yeah. Anyways,
Where do we go now?
Alignment of goals. You also mentioned something else, right? This, you said that you're an engineer and you like to control.
But don't tell anyone. It's like our little.
You're a
secret.
recovering engineer. You're a recovering engineer. You're hiding it behind the long hair and the affable personality. You said you like to control stuff, but on our onboarding call, you talked about this idea of this illusion of control and the need for it. Can you talk to me a little bit more about how you think about control these days?
Yeah. So it is like, I think control is this total illusion, but from like an asset standpoint, I think that there is such a higher degree of control when you compare it against other asset classes or other investments. Like we were talking about the stock market, and the companies could be anywhere of the world. They could have offices wherever. And like the three of us really can't affect the stock price of any company out there. Maybe we could argue, okay, we bought a crap ton of stuff on Amazon. The Amazon stock goes up 0.2%, whatever. Like that's not going to happen.
My wife might affect the Amazon stock price. I don't know.
Oh, that's too good. But versus like in the real estate world, if you do things to the property in alignment with like working with a property manager, with an agent that add value to the property, there is a much higher degree of control, I would argue. Now, of course, markets go up, markets go down. And in the single family space, if your neighbor's property sold for 200 grand, or the property across the street sold for 200 grand, I don't care if you have a gold plated toilet in your house, it's probably only going to sell for 200 grand. In the commercial space, because we're valuing properties based on cap rates and NOIs, that's a little bit different. If your property performs way better than mine, it's more valuable, even though they could be next door to each other. So there is just, I think, a much higher degree of control that someone has on the underlying investment itself, as opposed to alternative investments. And as a control freak, that's something that I like, as opposed to just being a participant on a roller coaster, strapping in for the ride.
I love it. I mean, that's when we talk about why you should be buying this property with JWB, we talk about how we want to control the things that we can control, where we largely talk about rent collection. We talk about keeping low maintenance and vacancy costs, right? We talk about those things because that's what we have a high degree of control over. We know tax savings are going to happen. We know principal pay down is going to happen. That's built into it. But then when it comes to something that we don't have a high degree of control over, you talk about home price appreciation. That's why we say, listen, you've got to hold on for a full market cycle to be able to enjoy that, to be able to benefit from it. It's because no matter how great of a job JWB does, if you're only holding on this thing for 3 years, you're more in the band of what is going on in the very short-term economy and real estate market, and less what JWB can do for you. If you hold on for 10 or 20 years, you just got to ride that wave of what growth has done in that entire market, and it's going to become cyclical. So there's two kind of like, I look at rental property investing as two different ways to make the decision. There's the things that are controllable, and you set yourself up for success when you have that, call it real estate agent and property manager linked together. They're the same person or the same decision-making entity. And then, the appreciation thing, depending on your horizon, that's really where you can kind of bet on it or not.
Totally. And I mean, if you look at a graph, like what real estate's done over the last 30 years, like it's up and to the right. Like if you pick a long enough time, right, it's up and to the right. And so if you start zooming in on the graph, of course you can find when things go down. But like you mentioned, if you're in it for the long haul, like it's going up and to the right.
So when you buy your rental property, because this is a topic we talk about a lot, as the buy and hold mentality, the holding on for 10 or 20 years, and why it makes so much sense. It sounds like you've held your portfolio. You started in 2012 owning those properties? Is that?
Yeah. First property was like 2013, 2014 was purchased.
So you're just at about 10 years. Could you give people a sense of the size of the holdings that you have, how many properties, how long you've held them, and then what does it feel like to own these properties after 10 years and to see the beginnings of what it really looks like for a full real estate market cycle?
Yeah, totally. So today I'm at like 62 units, I think.
Wow.
Just closed on one the other week. Thanks so much. And actually, I just sold my very first property that I purchased from Marietta, which was kind of weird to do, like from an emotional standpoint, was a bit odd. But I've held on to the vast majority of everything I've ever purchased because I'm very much buy and hold investor. And then I've been doing a lot of value add over the last 5, 6, 7 years. And so some of those stuff I sold just because I was trimming the portfolio of stuff's kind of a headache, add the value, take advantage of where the market is, sell it, move it into something else that's a little bit easier. But it's just like, it's remarkable as you start to build up your portfolio. It's kind of like a fine wine for anyone that enjoys wine. Like I think it just gets better with time because you start to get into this rhythm, into this groove. And what I think a lot of people don't recognize is like when they're first getting started, again, just kind of like dating someone, you're figuring out them, they're figuring out you, and the property is involved in this, maybe we'll call it a menage a trois relationship. And so you're like, everyone's figuring each other out and things don't always go amazing. As you be with someone longer, like a partner, it just gets easier because you know how they operate, they know how you operate, and things get better with time. And so in real estate, I mean, you guys know this better than anyone, we tend to see the returns go up with time. Right. Oftentimes your debt is fixed. Your expenses might grow a little bit with inflation in terms of goods and services, and maybe your taxes grow a little bit depending on what market you're in, but your rent should hopefully outpace all of those things. Right. And so when we have our income outpacing our expenses on a growth trajectory, things start to get really good really fast.
And I would love to get your opinion on this, but like, I feel as real estate guys, like we are, like the three of us are now, welcome to the club.
I got three now.
Yeah, the majority of our friends in the Not Your Average Investor Show community are, right? I feel like, we have to be sort of on the defensive when it comes to, hey, listen, this is a buy and hold strategy. This is a buy and hold mentality, almost to where like that's a downside to this investment. Where if you compare it again, this double standard that I keep, banging on in the stock market, people talk to me about why they invest in the stock market. And they're like, listen, I'm going to buy it. I'm going to hold on to it forever. And I know I'm going to earn 10% year over year. I'm like, why is it so okay to have this mentality that you're going to be buying and holding in the stock market? But in real estate, people are like, oh, geez, don't lock me down. I don't want to buy and hold here. Like, why is that? What's your impression on that?
Yeah. So I think it's a couple things. So one is, for the longest time, real estate was a semi-illiquid asset. You and I, if we own stocks, I could buy today, sell it tomorrow without click of a button. Real estate was much tougher to do for the longest time. Roofstock has changed that a little bit. And so I think the single family asset class just in general has become a much more liquid asset. It still takes time to sell, prepping, whatever. And so your transaction between when you decide to sell and when the money shows up your bank account, there's still a fairly long lead time on that, but it's becoming shorter and shorter. And also, I think, Greg, that people just don't look at the total return. And that's easy. Like, it's super easy to quantify that for the stock market. I invested 1,000. Now I have 1,500. This is my return.
Right.
Versus in real estate, you invested X and then you have probably Y in cash flow. And so that's the return that people are looking at. But what they're forgetting is that loan pay down. Every single month, they're buying equity in the property. They also get tax benefits and they also get appreciation. So just like someone would say, oh, my stock portfolio went from 1,000 to 1,500, real estate investors should be saying, well, my property went from 100,000 to 120,000. Oh, and by the way, I only put 20 grand into it. So I just made 100% return. So you can take your 15% stock market returns and get out of here. Just like you have to look at the whole picture. Yeah. Yeah. You have to look at the whole picture.
Gosh, I love this guy. Can we have like a resonance spot for Michael?
Yeah, sure. I'm not jealous at all. Go ahead. He's probably a better surfer than me. All you have to do is be able to catch one.
Probably is a better surfer.
Yeah.
Do you guys think I could get like an invite to the next Sunrise Beach Walk though? Like, are we doing this?
Man.
Yeah, I think so.
Wait, you're just gonna let him in on the beach walk now? Keep that between us. Goodness.
You're in, buddy. I think I would love. I think it'd be awesome if you came on June 24th for a super duper meetup, man. I don't know if you can squeeze. It's probably short term, right?
Yeah.
But we are doing quarterly meetups here in Jacksonville, man, and showing like, I don't know if you know this, but speaking of this whole like controlling the whole equation, these guys, the JWB has purchased like 19 blocks of downtown Jacksonville, and they're going really, really hard at this like developing the urban core, because all of the JWB neighborhoods are within a stone's throw of the urban core, and it's all workforce housing. So like the value add that you're talking about, they're uniquely doing this on like a macro scale here in the economy, because they're like a bunch of dudes that want their younger kids to like graduate college and live here. Right. So it's a really interesting thing that I think you'd love to see. You'd get a good walk on the beach with us. If there's some rain, I'll take you out, buddy. So, the invite's on the table.
Thank you. Thank you very much. Yeah, Greg, we were talking about that when you came on the Remote Real Estate Investor. It's super, super cool to hear.
Yeah, it's fun because it's a decision that we're making, not in search of the best return on investment for JWB. This is not something that we are going to be packaging up and selling to clients. This is done for the community. This is a little bit of a labor of love because the return on investment we're earning is like way low. Think like we're going to earn like 2% on our money. And, that's not good for JWB to do that. So we're going to accept a very, very low return on investment. We're spending years putting these properties back online, $20 million of renovations. And we're doing it to be a major force in the renovation and the revitalization of downtown Jacksonville, because we live here and we want to enjoy this, and we know that somebody needs to take the lead in doing things like this. And we can't all wait for our owner of our NFL football team to do it, which he's amazing. We love the Jaguars. We love their impression, but they need more help from the small to medium guys too. So it's fun to do things that will benefit our clients so dramatically. It will benefit JWB long haul if we're right on this, right? I mean, we're getting in at a ground floor price right now. We expect Jacksonville's overall downtown to be worth a lot more in the future. So we're hoping to benefit from that. But it just feels right. Like we have a platform to do good. We have a platform to impact the community. We do that in a number of ways. And that is the most exciting thing about this. I can tell you, it's not the returns.
No, that's awesome, you guys. But it's funny because in 10, 20, 30 years, whatever the time horizon is, when Jacksonville is the new Miami, people would be like, oh, JWB is so lucky. Like they got so lucky they bought there 20 years. It's like, no, they're not lucky. They were they were doing a good thing, and B, they had a vision for long-term growth.
Did you get any of that when you were buying your first property that, you're crazy? Like, what are you doing? You're buying something 6 hours away or 3 hours away or whatever. And now,
Totally.
10 years later, people look at you like, man, you had it lined up. It was so easy for you. It's so much harder for me. Do you get a lot of that still?
Absolutely. Absolutely. And yeah, I mean, the whole remote thing is a whole nother layer of complexity. But I first started investing, friends like, you're so dumb. Like, stock market's easy. Why are you doing that? And now they're like, oh, damn, that's pretty crazy.
I wanted to ask specifically, I think it's really timely that you just sold your first ever property, because I think it helps kind of pull in a lot of these concepts we've been talking about, how cash flow is important, but it is important to look at those other profit centers as well. I'm sure you don't have the numbers in front of you, but if you had to estimate out of the total package of your total returns on a percentage basis, what would home price appreciation, now that you've held on for roughly 10 years, account for versus that cash flow component?
Yeah, many hundreds percent. Like, like it blew it out of the water. Like $200 a year when I started, and then because of the rental appreciation over time, I think I was making $400 or $500 a month, something like that. But the property doubled in value over that time.
And what
So,
if you said, listen, I like this one at 200, but I really want 225 in cash flow. And you didn't do that deal.
I would be
what would you
kicking myself.
There you go, right? It's all these profit centers. It's about the management that you have in place, right? The resource that you had with the agent. It sounds like you had a wonderful relationship with that person, right? It's all of these other things that go in line. So if you are that person out there who is thinking about how you have it lined up, right? Let's say you're thinking about buying properties with JWB. We're the right team, right? Jacksonville's the right market. This is the right type of asset. And you're like, oh man, my buddy just told me that I could earn like $150 a month in cash flow. This one's only offering 75 or 100. Think about this, right? It is so hard to get all of these things lined up. If there's one thing to give on, giving up 25 or 55 or $75 a month in cash flow, if it's still cash flow positive, give that up all day, every day.
Yes. And I think too, just like to further that point in talking about the total return, go talk to your CPA and find out what owning that rental property is going to do to your taxes for the next year. Because when you think about like, oh man, I'm not making 150, but by the way, I'm going to be able to write off $6,000 against my W-2 earned income, and that's going to offset my taxes by whatever, $300 a year. You just created that $25 delta right there. So maybe it's not as big a deal as we think.
That makes a lot of sense. All right, Michael, let's get into a little bit of Q&A, man. You ready for that?
Let's do it.
All right. Miguel Angel Sanudo, who is a foreign investor, right? He lives in Andalusia in Granada, Spain. He asks, Michael, are you investing in real estate in a foreign country, and how comfortable are you with doing that? Any advice?
Yes. So great question. I invest in short-term rentals out in Portugal, actually. So my wife and I just got our permanent resident status for Portugal. And that was the whole reason behind it. Was Portugal has a program where basically you can get a visa and then an ultimate passport with non-habitational residency. So I got to go to Portugal for 14 days every 2 years, like boohoo, poor me. And so we bought two rental properties out there. And so those are both Airbnbs. Comfortability wise, I did a ton of homework. Again, I'm someone that's very much control freak. So I did a ton of homework, met with a ton of people, interviewed different agencies and attorneys and folks on the ground to understand what this process was like. And it was assured that Portugal is a very safe place to invest from a legal standpoint. So we were fairly comfortable going in. What I didn't account for, which I would highly recommend, is if you are considering a foreign investment, convert your currency sooner rather than later, because you know what the price is. So I was investigating investing, say that 5 times fast, in Portugal. And I was there in February, March, April of 2020. Now, we all know what happened March, April 2020. And so the dollar up against the euro was going up. It was like 94, 95, 96 cents against the euro. So I was like, sweet, this is going to be like a 1-to-1. Didn't convert my money because I got greedy and I wanted to wait till it hit 1 or surpassed 1. COVID hit, dollar went down like 82 cents against the euro. And that's when I did like the bulk of my converting, because I was like, well, crap, I don't want it to go any lower. So that part sucks. Like that really, really sucks. So if you are thinking about foreign property investment, think about, okay, if you converted at today's exchange rate, how comfortable are you with that return? If you're comfortable, do it. Don't gamble, because it can definitely go the other way on you.
Yeah, it sounds like, because you would have put sometimes months and maybe spent thousands of dollars setting this up, only to find out at the last second that you might have $50,000 less to invest in it. Yeah, that's painful. That's a really good point. So I appreciate you bringing that one up, buddy.
Yeah, totally.
What's up, man? Great advice, Miguel Angel. For you, man, that's Iberian Peninsula, man, right down the street. So Jag Chata has got a question. Could you talk about how you financed your portfolio growth, right? So you've been in this for like 10 years. Can you talk about the journey of how you started with your financing and the things what you're doing these days that has to do with leverage?
Yeah, totally. So I started with friends and family capital. I was like, hey, I know someone that has some money that they just have it in the bank earning 0.02%. I said, give it to me. I'll pay you a better return on your money, and win-win. And then I just started getting traditional bank loans, and I've used commercial financing. I partnered up on some deals where I didn't have the capital myself. So I said, hey, I'll bring the deal and the hustle. You bring the capital. We'll partner up on this thing and split everything down the middle. So a number of different ways. And I think that there is so much money out there in the world, whether it's from a bank or from friends and family or from private capital, whatever it is, like people want to get into real estate and not everyone knows how, or not everyone cares to know how. So go find someone that has whatever it is you don't, and they can make a great partner. And I think so many people are like, oh, like, I don't want to give away half a deal or whatever. It's like, I'd rather have 50% of a big deal than 100% of nothing.
Yeah.
Love it. I mean, how many times do we get this question on the show? I'd like to get into rental property investing, but I don't have money, and that's what's holding me back, right? What Michael just talked about there were 3 or 4 different strategies where he didn't have to use his own capital to get out there and start to build a portfolio that's now is 62 properties, of which he sold a few right now in 9, 10 short years here. Right. Yeah. So I always tell people, if the obstacle is money, that's what's holding you back. That's actually the easiest obstacle to overcome. It really is. And Michael's just a great example of that.
What about as it matured, Michael? Like nowadays, right? Are you still financing stuff? Are you buying stuff cash? Are you taking out equity and doing things? Can you talk a little bit about how financing changes once you're over that first hump?
Yeah, totally. So my wife and I purchased our first primary back in 2018. And so we took out a HELOC on that, have used that to invest, purchased a new primary here in California, in Northern California. We're house hacking that. So we're getting some money coming in through that. But it's mostly traditional financing, to be perfectly honest, like, especially with where the interest rate environment was for the last year. I spent like the last 8 months lining up all of my financing for all of my properties to get it really tight to where I wanted it and cashing out as much as I could. So levering up maximally, getting in the longest term fixed debt I could, because the Fed announced it like it was not a secret that they were going to be raising interest rates. I think it caught people by surprise how much and how fast, but it was like they told us. So I was like, oh, shoot, I better do something to protect myself. So commercial financing has been great. I investigated a DSCR loan, which is a debt service coverage ratio loan, which is kind of like a commercial loan. I've toyed around with those in the past. So there's all kinds of different loan products out there, depending on what it is you're trying to accomplish, like fix and flip loans, bridge loans. Like there's so much more financing options now today than there was like 10 years ago. So I think people, again, thinking about goals, think about what it is you're trying to accomplish, and then go look for the type of financing that aligns with those goals. It doesn't have to be from a bank. Like, again, it could be friends, family, whatever. It could be your network.
Absolutely. I mean, the financing thing really trips people up, and people have heard things from their friends or other people in real estate that might not be so up with some of these options. And they'll say things like, well, geez, if I already own, a rental property, I'm not going to be able to get financed for another. Well, that's not really the case, right? You're buying an asset that produces more cash flow than the expenses. And so there are lenders out there, there's a lot of them, that allow you to count the rental income to offset the debt payment. So boom, if you have one property and you have the down payment requirement, you have a good credit score, it's very likely you're going to be able to get approved for 2 properties, 3 properties, 5 properties. So, don't take that excuse as holding you back. Or now people will say, geez, if I have 10 properties on my credit, I can't go out and get a loan at great rates, right? Well, that's not real. Michael's talking about these loan products here, and DSCR products are one type of them, where the lenders out there don't have this 10 finance property rule like Fannie Mae products have. They look at this lending opportunity based on the fundamentals of the property, which is the same way we all make decisions. And so they're like, listen, if this property cash flows, that's another fancy way of saying DSCR, debt service coverage ratio. If there's enough income coming from this property, we're going to lend on it all day. You want 100 of them? We're going to lend on it, right? These are the type of packages that JWB has used for our 300 rental properties, these types of loan products. And they're available to everybody now. They weren't always available. You had to have a lot of net worth, or you had to have a lot of properties for it to make sense. And they're available now. So again, going back to the financing and the capital thing, like, I hope everybody realizes the tools and the opportunities and the resources you have at your disposal now, which Michael didn't have in 2012 when he started, which I didn't have in 2006 when I started.
Yeah. And I think people too, need to get comfortable with a little bit of rejection, because I've talked to tons of lenders that are like, no, we can't lend on that deal. No, we're not going to lend to you as a borrower. And if I had been like, oh, bummer, I guess I can't invest in real estate, I'd be in a very different position than I am today. And so just go keep calling people and reaching out to people until you get a yes.
Yeah.
I'm willing. I never make promises. I'll kind of promise with an asterisk. You'll probably get a yes at some point down the road. There is a lender out there that will lend to you based on whatever your situation is. You just have to go find them.
Yeah. Listen, one of the big reasons why we started this content stream like this, right, with the community aspect, folks showing up live, the Facebook group that we went really hard at, is because part of that is this idea of having a network around you that can give you this kind of advice, right? Like not just give you this kind of advice, but also point you to the person that they used whenever for whatever situation, right? So like I think this is one of the things I like the most about the real estate community, is this community aspect of it, right? Like this idea that everybody sees value in somebody else. We see a ton of value in Camille being here and Lee being here and Nadeem being here and folks just commenting in the chat, adding value to each other and being able to like have these different like contextual examples, right? So if you are here, I just want to do a quick plug for the Facebook group. Like go to the Not Your Average Investor Facebook group and hang out there. We got 3,500 people that are actually something like that. We're close to 4,000 these days.
We are.
Yeah. That have seen stuff like this. Connect with Michael on LinkedIn or whatever. What is your platform du jour that you'd like to connect on, Michael?
LinkedIn and Twitter are probably my two favorite.
Yeah, LinkedIn and Twitter. Hook up with him on LinkedIn and Twitter. I'm gonna keep going to the Q&A, but I also I think that once we get down this path, I like to preach the power of community and networking and the stuff that we're doing of just being able to get this type of advice. I think is so good, man. All right. So Leslie Wilson out of Denver, she's got a question. Could Michael comment about the fact that Wall Street is getting into the single family rental market? First time home buyers can't compete with them, and there's a lot of bad press about it. What do you think about that?
Yeah, I mean, I think that there is a lot of truth to that, but it's funny because it's you could almost spin it the other way, because if Wall Street's getting involved in it, doesn't that tell us that there's like a reason that there's money to be made there? So I'm a big fan of like riding other people's coattails. There are tons and tons and tons and tons and tons of investors out there that are smarter, wiser, more experienced than me. And so I don't have to reinvent the wheel. And so if I look to see what they're doing or what companies like Amazon or Whole Foods are doing, well, I know that they have employees that are vetting the markets in which they're going into. So I still need to do my due diligence, but like, that's a great sign. So look for that kind of stuff. And so a lot of these institutional capital players and the Wall Street players are getting involved in very primary markets, the Denvers, the New Yorks, the Miamis, less so Birmingham, but like those kind of primary markets. So go look for secondary and tertiary markets where those players aren't as big. If you're just starting out, go get your teeth cut there as a first-time home investor or first-time home buyer and start there. Now, if you're someone that's like, I'm trying to buy a home to live in as a primary and I'm competing against institutional capital, I don't have a great answer other than think about it as what do you have? What leverage do you have? What angle do you have over those investors? And I would say the number one is like humanity and humility, because you're an individual person, you're a real person. You're not an LLC, you're not a Blackstone. And so I was just chatting with a friend of mine, they were competing against a house against investors. The owners said, we want to sell to a family. And so they ended up winning that bid. And so play to that, like write a letter. That's what we did with our place. We wrote a letter and said, hey, this is who we are. This is why we love the property. We see ourselves growing old here, kind of a thing. Do things that you can control, right? That you have control over, because the price and the financing, unfortunately, you're going to get beat out almost every time.
Yeah, absolutely. I like your approach of showing not there's pros and cons to everything. I worry less about trying to stop a force like Wall Street coming into single family rental properties and understanding what the pros would be for us overall. If you think about the hundreds of billions of dollars that are now in the single family rental space that was never there in 2007, 2008, 2009, 2010, right? That is a floor on what real estate markets could do. That is an excess amount of demand that was just never there. And so, one of the reasons people come to this asset class is because we want consistency. One of the reasons we're not happy with the stock market, even though we know we can earn 10% or returns each and every year, is that they go like this and they go like this and they go like this and they go like this. So we're in search of consistency. It's one of the things that appeals to folks about rental property investing. Well, demand coming from Wall Street, this institutional model, which is now what we have in single family rental properties, is here to stay. It's not a flash in the pan. And that creates even more stability and consistency for this overall model. So and then as an investor, like I like your point, like follow the big guys. Why are they making this decision to spend a lot of money to come into this asset class? Is because They're looking for inflation hedging, right? They now have this ability. Institutions now have, Wall Street has this ability because of technology to now make this scalable. And they're looking for opportunities to put their money where it is inflation protected and there's hard assets and you can get really inexpensive debt, and boom, they're in and they're not going anywhere. So I do want to be sensitive to those who are trying to buy houses as an individual, but for us as an overall asset class, there's a lot of things to like about this too.
Yeah. I think you hit the nail on the head.
Awesome. I think this is a good landing spot for today, Michael. I think this has been a ton of fun, man. Like, you've been a blast to hang out with, super informative. Like, I think that your perspective as somebody that educates so many people across so many markets, and your life experience and all the stuff that you're doing just make you this like amazing wealth of, plus you have this engineer mind with a great personality, right? Like, just make you this like great wealth of resource that, I don't know, man. I just want to spend more time picking your brain. I think maybe we have him back some point soon.
Love it.
Take a sunrise walk on the beach, whatever, no big deal. But I just really appreciate the way that you showed up here, your energy, all the value that you put out there. The community's really loved it. Great questions from the community. I want to thank those of you that came. 46 people on the call.
Love that.
A sign of a great guest is that the ticker starts rising, right? Like, we started off with like mid 30s. We got up to the mid high 40s. Michael, that's a testament to you, man. And it's a testament to those of you that take an hour out of your day on a Tuesday to just join us, add value to this community, add value to the show. That never goes uncertain. If you were listening to this on the podcast before we sign off here, we would highly encourage that you just go to nyais.com one of these days, throw it on your calendar, show up when you can. And GC, I'll let you kind of, you know what? I also want to call out, Friday is last call for our Super D-Duper meetup.
Yes.
It's next Friday, so we need a final head count. So we get the TikTok. What is it called? The
Tuk-tuks.
The tuk-tuks. We're
Nobody knows what that is.
We're tucking around. We're tucking around downtown Jacksonville. We got these little carts with chauffeurs. It's a lot of fun. It's like if you're in like rural Thailand, but you're in Jacksonville because you're in a tuk-tuk. Yeah, it's wonderful. Really, it's going to be a great time. Go to jwbmeetups.com, register, join us here. It's going to be a fun time. We got like 50, 60 people coming. It's going to be great.
60,000, I heard.
60,000 people. We're going to fill an NFL arena with investors.
It's a lot of tuk-tuks.
Yeah.
A lot of tuk-tuks.
GC, I'll let you get some words in before we give Michael last.
Michael, this has been awesome. Before I forget, Michael, please tell us how folks can get a hold of you. Is there something special they should go to, or just find you on LinkedIn or Twitter? Where should they go to find you?
Yeah, LinkedIn's great. Twitter's great. You can reach out to me directly. You can also check us out at the Remote Real Estate Investor, our podcast that we host. And then also I'm all over the place at Roofstock Academy as well, which is roofstockacademy.com.
And we love our friends over at Roofstock. JWB and Roofstock have partnered up on a number of things over the years. We actually recommend clients who are at that point where liquidating their properties makes sense. We actually work together with our clients and recommend them use Roofstock as a way to liquidate. So talking about how you're creating this more liquid asset class here. We love our friends over at Roofstock. So, and the Remote Real Estate Investor podcast, go check that one out. I listen to it all the time, and Michael was kind enough to have me as a guest not too long ago. So, beyond that, man, really appreciate you. I really appreciate the friendship we built, over the last few months now. Feel like we're brothers from another mother.
Absolutely.
In our real estate approach. And it's just been awesome having you on the show. I love bringing guests on. There's just an instant connection. We think the same about real estate. We've seen the success. We're able to help others. And you're just a pleasure to kind of share your story with the community. So thank you so much, man. I hope we can have you back sometime soon.
Thank you, guys. Really appreciate you taking the time, having me on, and keep adding value to all your guests and your community. Clearly, you're killing it. So thank you for that, for helping spread the good word.
Michael, before we sign off here, man, you've educated all sorts of people. You get all sorts of questions. What's kind of like your go-to piece of advice when someone's like, I'm thinking about getting into real estate? Do you have like your usual kind of like what the way that you send people?
Yeah, I think it's like all about education. You have to understand what you're doing, and you have to understand what the risks are. Because the one thing it just grinds my gears is I'll talk to someone like, oh, you invest in real estate, whatever. And they're like, oh yeah, I did it back 20 years ago and it got totally burned. Never do it again. Like, that's real estate sucks. I'm like, no, what a missed opportunity. And we talk into more about how they did it and why they did it. And I was like, yeah, speculation. And my buddy was buying property in 2007 and they said it was going to go up 30%. And now I got burned, It's like, okay, well, that's like black or red at the casino. That's not necessarily real estate investing. So Go understand get clear on your goals, why you're investing, what you're trying to accomplish, and what the risks are, now I think you're in a place that you're ready to take that leap.
There you go. If you want to build cash flow, build wealth, have a portfolio like Michael, travel around in a van, be super cool, you got to get educated, and you can't be an average investor. See ya.